Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation.
And it has been a genuinely consequential week to synthesize. We've seen major policy decisions impacting the bedrock of retail confidence.
I'm Alex.
And I'm Jamie. Our mission in this deep dive is to really extract the critical insights from, well, a very diverse set of sources.
Yeah, we're unpacking a week that's been defined by the strengthening of the UK's financial safety net, some fresh ONS data, and a really fascinating paradox about AI efficiency.
So we'll start with the PRA's big boost to the FSCS limit, which interestingly was higher than first proposed.
Right. And then we'll look at why the Basel Committee is scrapping its, let's be honest, highly controversial 1,250% crypto capital rule after some intense pressure.
And on the macro front, we dive into the latest ONS figures. The headline CPI might look like it's easing, but the painful reality of rising food costs tells a very different story for consumers.
It certainly does. So let's jump straight in. Okay, let's get into the realm of regulatory resilience. Segment 1, depositor confidence. For retail banks, the biggest policy news this week has to be the PRA's confirmed increase to the FSCS deposit protection limit.
It's a material shift, absolutely. We're moving from the current £85,000 up to a new level of £120,000.
And that's effective from the 1st of December 2025.
That's right.
But what's really noteworthy here is that the regulator went beyond its original proposal. They'd floated £110,000, but then they pushed it up. Why the extra jump?
Well, the PRA explicitly linked it to maintaining public trust and, crucially, accounting for inflation. They basically said that raising it to £120,000 better reflects the impact of recent high inflation on household savings.
So it's a real terms adjustment, essentially.
Exactly. It's a very tangible, pragmatic effort to maintain confidence in the system's ability to protect the average saver.
And it's not just standard savings, is it? The protection for temporary high balances money from, say, a house sale or an inheritance, that's also rising substantially.
Yeah, that's going from £1 million up to £1.4 million. Hugely important for mortgage lenders and wealth managers.
So for our audience in retail and ops, the administrative requirements are pretty clear.
Oh, yes. Firms had to get all their FSCS disclosure materials, updated information sheets, website copy, branch displays by the end of May 2026. So planning needs to start now, really.
Right. Now, speaking of retail banking and sentiment, we have to contrast that regulatory stability with the dose of reality hitting the fintech valuation market.
The Lloyd's acquisition of Curve.
What a striking deal.
It really was. Curve was bought for just $120 million on. And this, as reported in the Times, just perfectly illustrates the current climate.
I mean, the founder once publicly targeted a valuation of what, $50 to $60 billion?
Billion, yes. So to sell for $120 million, well, that's significantly less than the $250 million they'd already raised in funding.
That is a brutal reality check.
It absolutely is. It signals what some are calling deflated ambitions right across the fintech sector. It just underscores that investors in big banks now want profitability, not just user growth. The party, I think it's fair to say, is over.
So that FSCS uplift anchors retail confidence, but let's shift focus now to the macro headwinds. We turn to the latest ONS data for October 2025.
And numerically, the headlines suggest progress. The annual CPI fell to 3.6%, down from 3.8%.
And CPIH, the one that includes housing costs, also dropped to 3.8%.
Right. And the core measure, core CPIH, which strips out all the volatile stuff like food and energy, that hit 3.7%, its lowest since late 2021. So on paper, the trend is easing.
But it's a big but, isn't it?
It is. Here's the critical disconnect. While those headline rates slowed, the ONS confirmed that inflation for essential food and non-alcoholic beverages actually rose to 4.9%.
And that made the single largest upward contribution to the change this month. So people are feeling it in the supermarket, regardless of what the headline number says.
That's the profound question, isn't it? The macroeconomic statistics paint one picture, but the cost of living that people feel every week is a very different and much more challenging one.
Which for banks translates directly into pressure on loan books and affordability.
Exactly. And compounding that pressure is the fiscal picture. The ONS Public Sector Finances Report for October was, well, it was grim.
Borrowing was $17.4 billion. That's the third highest October borrowing since records began in '93.
And the cumulative picture for the financial year so far is even more sobering. Borrowing hit $116.8 billion.
The second highest figure on record, only beaten by the peak of the pandemic in 2020.
And all of this stress contributes to the UK's massive debt load.
Which is still stubbornly high. Public sector net debt is provisionally at 94.5% of GDP.
A level we haven't officially seen since the early 1960s. So you've got high debt, high food inflation, political uncertainty. It's a perfect storm for policy risk.
And that risk, naturally, always flows back to the banking sector. We've seen renewed rumors that the Shadow Chancellor is looking at increasing the existing 3% surcharge on bank profits.
And that creates immense planning uncertainty for strategic teams. I mean, that's on top of the 25% corporation tax already.
It feeds into a much wider and, frankly, quite negative sentiment. We heard sharp critiques this week from Andy Haldane, former chief economist at the Bank of England.
Right. He said the chancellor had been dealt a bad hand, but has played it poorly, and that her growth efforts are not even close to doing enough.
And it's not just former regulators. The billionaire Jonathan Oppenheimer, quoted in The Telegraph, just labeled the UK uninvestable.
Yeah, that was a damning quote. He said straightforward projects can take 30 years to do a 9-month project. That really hits at the heart of where global capital decides to land.
Okay, let's pivot sharply from high-level economics to the very practical challenges facing compliance and financial crime teams. Segment 3. And we have to start with the National Crime Agency's Operation Destabilize.
This was frightening. It exposed a billion-dollar money laundering network, active across at least 28 UK cities.
And the mechanism here is the crucial takeaway for regulated firms, isn't it? This goes way beyond simple shell companies.
It does. The NCA found this network explicitly purchased a Kyrgyzstan-based bank, Kermet Bank, to serve as a designated vehicle.
A vehicle for what, exactly?
Two things: to facilitate sanctions evasion and to provide financial support for the Russian military-industrial base. The method is converting dirty cash from drugs and firearms into clean crypto, then funneling it through this compromised foreign bank.
So the immediate risk for UK banks is being unwittingly connected to this through correspondent banking.
Precisely. It forces institutions to deepen their scrutiny of those relationships and pay extreme attention to crypto off-ramps, especially from certain jurisdictions.
Right. Now, moving to conduct risk, we have that tightrope walk between AML duties and financial inclusion, highlighted by the Barclays case.
Yes, the entrepreneur Madeleine Thomas, who accused Barclays of closing her accounts.
Allegedly because of income from OnlyFans, even though she also runs a legitimate tech startup.
And the FCA has been very clear in the past, warning banks against unfairly denying access to people in the legal adult entertainment industry.
So what was Barclays' defense?
They emphasize their responsibility to understand the source of funds when banking a business, regardless of the nature of that business. It just perfectly illustrates that clash between AML obligations and the conduct rules on fair access.
It's a very fine line to walk.
It is. Now, before we leave compliance, we have to cover the major global shift on crypto capital rules. The Basel Committee is officially reworking its notorious 1,250% crypto rule.
This is a genuine regulatory U-turn, isn't it?
It really is. That rule was designed to be a near-prohibitive barrier, requiring a pound of capital for every pound of crypto exposure.
So why the sudden reversal? It was central to their original framework.
It failed because major jurisdictions, including the U.S. Fed and our own Bank of England, basically deemed it unworkable.
Right. The FT and CoinDesk reported on this.
Yeah, the worry was it would just drive legitimate activity offshore, away from proper oversight. So this signals a shift towards a more nuanced capital treatment, trying to open up regulated pathways for banks.
We turn now to operational resilience and the future plumbing of the markets, starting with HM Treasury's policy note on T+1 settlement. This is a massive change coming down the track.
It's a profound shift, yeah. The UK is mandating that trades settle one day after the trade date T+1 for securities on a UK trading venue.
And the deadline is 11 October 2027. What are the key practical implications for back offices?
Well, it requires vast system upgrades. Cutting the settlement cycle in half dramatically reduces the window for processing, matching, funding, everything.
It puts huge pressure on operating costs.
And liquidity, especially when you're trading across time zones. You just have far less time to manage currency conversions and funding calls.
And critically, there's a big exemption here that liquidity managers will have noted.
Yes. Securities financing transactions, SFTs, so things like securities lending and repo deals, will be exempt.
Which is vital.
It is. SFTs are the lifeblood of liquidity management. Exempting them shows the regulator is balancing the need for speed with the need for flexibility in the markets.
Okay, now let's move to the AI paradox. This is a brilliant warning about how we measure cost efficiency. Klarna is the case study.
Right, so the headline is fantastic. Their AI agent now does the work of 853 employees, saving an estimated $60 million a year.
A huge saving. But here is the critical counterintuitive twist.
Despite saving $60 million in staff costs, Klarna's overall customer service and operations costs actually rose in the last quarter.
Wait, hang on, how is that possible? They save $60 million, but the total bill goes up.
It went up to $50 million from $42 million a year ago. It completely defies the simple narrative of AI efficiency.
So what's driving the cost up?
It's the cost of complexity. The AI handles the simple repetitive stuff, but the queries that still need a human are now more complex, more nuanced. So you have fewer, but more highly paid specialists dealing with the really tricky stuff.
And managing the AI itself, I imagine.
Exactly. Training the models, managing the errors, it's a critical lesson. The cost of managing the remaining human-level complexity can often outweigh the savings from automating simple tasks.
A really important point. Finally, on resilience, the Bank of England and PRA released the results of the life insurance stress test, LIS 2025.
The first test under the new Solvency UK regime. The sector showed resilience. All firms met the requirements.
But the aggregate capital coverage did fall substantially post-stress, from 185% down to 154%. What was the key exposure they identified?
It was a material exposure to residential property value falls, mainly driven by their big holdings of equity release mortgages, or ERMs.
So a very targeted risk the regulator is watching. And they're also scrutinizing something called funded reinsurance recapture risk. What's that about?
Funded re is where an insurer transfers a big block of liabilities to a third party, often offshore, to free up capital. The recapture risk is that if that third party fails, the UK insurer has to take all those liabilities back.
Ah, so it's a potential snapback of risk onto the balance sheet.
Precisely. And the PRA is now considering if further capital action is needed, which suggests they see this as a growing systemic concern. So let's quickly recap the major shifts this week. We saw the PRA significantly boost depositor confidence, raising the FSCS limit to £120,000 and explicitly linking that to inflation.
Right. And globally, the Basel Committee performed that major retreat, scrapping the unworkable 1,250% crypto rule, which signals a more pragmatic path forward for digital assets.
Then there was the harsh fiscal reality from the ONS. Stubborn, rising food inflation set against historically high government borrowing and the persistent threat of a bank tax surcharge.
And for compliance teams, that NCA operation exposing a sophisticated billion-dollar money laundering network using a foreign bank for sanctions evasion.
The theme tying a lot of this together, though, is that tension between cost efficiency and resilience. Klarna proved that saving money on staff doesn't mean a cheaper operational bill if you fail to manage the resulting complexity.
And that complexity isn't just about human oversight. The huge Cloudflare outage we saw this week wasn't an external attack. It was an internal security configuration file that just, and I quote, grew beyond an expected size of entries. The core takeaway is that the source of the next major operational risk is often not the outside threat, but the sheer uncontrollable complexity we build into our own systems. Whether they're digital networks or intricate capital rules, definitely something to mull over.
That's all from us this week. Thanks for listening to RegTalkUK. Until next time, stay sharp and stay compliant.